Welcome to the deep dive. If you're looking for a shortcut to understanding the future well, the measured, mathematically predicted future, you've definitely come to the right place. Today, we are diving deep into actuarial science. It's this high-stakes world of professional risk calculation. Our mission today, pretty clear. We're unpacking how actuaries are using their, frankly, ancient discipline and applying it to some really massive modern problems. We're talking everything from keeping public health systems afloat financially to figuring out the incredible financial uncertainty that comes with climate change. And maybe the biggest piece, we're dissecting how artificial intelligence isn't just helping them anymore, it's fundamentally rewriting their whole toolkit.
Right. Actuarial science, at its very core, it's this highly specialized field. It uses sophisticated statistical mathematical methods to look at financial risk. You see it mainly in insurance, pensions, finance. It's really the job of calculating the odds of uncertain future events happening and then designing the financial setups needed to, well, lessen their impact.
Okay, so to really give you the context for this deep dive, we actually need to go back, way back, almost 4,000 years. The whole idea of managing risk, it's not new at all. Our sources point way, way back to 1750 BC. We're talking the Code of Hammurabi in ancient Babylon.
Yeah, and what's really fascinating there is how the Babylonians actually codified the system. It was called bottomry. It wasn't just a standard loan. Repayment depended entirely on whether the voyage was successful. If the cargo ship sank, perils of the sea, the loan was just wiped out. That's a formalized agreement. It transfers and compensates risk. It's the direct ancestor of the insurance contracts we see today.
Okay, so that ancient idea, it evolved, right? Through mutual aid societies, marine insurance in 14th century Italy,
Right.
and eventually it lands in the coffee houses of London. Those are the kind of business hubs back then. But the moment that really professionalized the field, the pivotal moment, came from maybe an unexpected place, astronomer.
That's right. We really mark the official birth of actuarial science with Edmund Halley's paper in 1693. And yes, it's the same Halley, the comet guy. He wasn't just looking up at the stars, he was looking at lifespans. He used these mortality tables from a city, Breslau, to calculate, really for the first time, exactly how much premium someone of a specific age should pay, all based on their statistical probability of dying. It was the first time we saw a scientific probability-based pricing for insurance.
And the actual title actuary, that came a bit later, didn't it, the 18th century?
It did, coined by the Equitable Life Assurance Society. It was for the official whose job it was to apply these new, very precise scientific methods.
So fast forward to today. When we talk about the core job of an actuary now, what does that actually look like in practice?
It means digging through immense amounts of data, really trying to estimate the economic cost of uncertainty, primarily for things like life insurance, pensions, annuities. Actuaries are the ones ensuring these institutions are financially sound. They do that by modifying potential risks and rigorously checking the financial reserves and capital the company absolutely must hold to meet all its future promises.
Okay, this brings us to a really valuable distinction, I think, for you, the listener. Actuarial risk.
Yeah.
Now, this isn't the risk of, say, the asset failing or the market crashing. Could you walk us through that difference?
Yeah, this is one of the deepest insights into the profession, I think. Actuarial risk isn't about the external event. It refers specifically to the risk that the actuary's own assumptions turn out to be wrong or inaccurate. Think about it like this. Financial risk is maybe worrying the ship will sink. Actuarial risk is realizing the map you use to calculate the insurance premium, maybe the mortality rates, how often losses happen, how severe claims are that map was drawn incorrectly. Managing the flaw in the map itself, managing the model risk, that's the ultimate professional tightrope they walk.
Now, while we often think of actuaries working behind the scenes in private finance, their modeling is actually critical in public policy, too. You flagged a really interesting case study about applying these methods to solidarity systems in healthcare.
Yes, we looked at Slovakia's compulsory health insurance rate. It operates on what's called the Bismarck model, basically, a social solidarity system funded through contributions. The real challenge there was figuring out a fair and financially sustainable rate for the economically inactive population, the IPO group. They rely heavily on state contributions.
Right, and that's a huge decision for public spending. So what did this sort of unbiased modeling show? And how did they maintain impartiality when dealing with what is, let's face it, a political issue?
Well, the actuarial modeling determined that the alternative financially appropriate rate for this IPO group should actually be set at 6.3% of the assessment base. Now, that was a pretty substantial change, 2.3 percentage points different from the existing official rate. The crucial thing here, and this is key, is the actuary's role isn't political. It's to provide the mathematical reality check. They don't debate the goal of solidarity. They quantify the financial cost of actually sustaining it using hard data. And that allows policymakers to make informed decisions, rather than purely emotional or political ones about public money.
Okay, so beyond just setting these basic rates, actuarial science is also carving out a pretty major role in health technology assessment, or HTA. How do they fit in when new drugs or technologies come along?
They really complement the traditional health economic analyses, but they focus specifically on the risk transfer. See, when a new expensive technology is adopted, the final cost is often uncertain. Actuaries model and compare different ways to pay for it. They analyze concepts like capitation. That's where a provider gets paid a fixed amount per patient, no matter how much care they actually use. So the provider absorbs the financial risk if costs run high. They compare that to things like risk based payments or other kinds of bundled arrangements. The key contribution really is clarifying who holds the financial risk, who holds the bag, so to speak. While economists might look at cost effectiveness, the actuary is looking at how that financial risk gets distributed and absorbed. And they're very clear about articulating the underlying assumptions, the specific limitations, and all the uncertainties in these models directly to the health decision makers. That's absolutely vital when you're moving towards value based pricing.
Right, let's pivot now to some of these emerging, really global risks. Climate change is obviously huge. Our sources are confirming the growing scientific view that global warming is probably going to exceed 1.5 degrees Celsius by 2100. That spells massive financial instability, potentially for everyone. But the deepest insight here isn't just about adding up storm damage costs, is it? It seems climate change has fundamentally broken one of the actuary's most trusted tools. Looking at the past,
That really is the paradigm shift. You just can't use the last 100 years of hurricane data, for example, to reliably predict the next 20 years. The underlying climate itself is changing too fast, so actuaries are now right on the front lines. They're using frameworks like the one from the TCFD, the Task Force on Climate-Related Financial Disclosures, to try and categorize and model this new volatility. We tend to divide the risks into two main types. First, you've got the physical risks. These include the obviously far acute events, severe floods, wildfires, major storms, things you see happen quickly. But maybe even more challenging are the chronic risks. These emerge slowly over decades. Think rising sea levels, shifts in where crops can grow because of sustained high temperatures, or even changes in where infectious diseases spread.
And that second category, transition risks, that sounds like it's all about policy and how markets react.
Exactly. That's the risk tied to the global shift towards a low-carbon economy. It's unavoidable, but the path is uncertain. So this means modeling the financial hit from new regulations. Maybe carbon taxes become widespread, or assessing market risks as consumer preferences rapidly move away from carbon-heavy products. Actuaries have to somehow quantify how these policy changes and market shifts will affect a company's bottom line long term.
Which must mean using scenario analysis much more heavily.
Yeah.
You're basically forced to build potential futures, not just predict based on the past. Which major bodies are providing the kinds of scenarios needed to test this sort of volatility?
Actuaries are relying heavily on standardized, quite sophisticated scenarios developed by big international bodies. You've got the International Energy Agency, IEA, the IPCC, the Intergovernmental Panel on Climate Change, and also the Network for Greening the Financial System, the NGFS. These scenarios give them a structured way to stress test a company's financial resilience against a whole range of possible futures. Everything from a smooth, well-managed transition to a low-carbon world, all the way up to a really chaotic, high-warming scenario where temperatures might exceed 3 degrees Celsius.
And modeling these incredibly complex scenarios, testing futures nobody's actually lived through yet, that requires computing power that just wasn't around a decade ago. Which brings us neatly to the new tools, AI and machine learning. It feels like they're becoming essential because the human brain alone just can't process the scale and, frankly, the weirdness of this new risk landscape.
Oh, absolutely. We're seeing integration everywhere, and it's moving way beyond simple statistical regressions now. For instance, the Casualty Actuarial Society runs this thing called the Actuary Challenge. It showcased projects like Risky Router. It's a machine learning concept designed to give a dynamic risk score for a driving route. It uses real-time factors, think hyperlocal weather, time of day, even aggregated driving data from telematics to spit out an instant, pretty accurate risk assessment for that specific trip.
Okay, so let's get tactical then. How is the average actuary actually using these large language models, LLMs, right now? Are they automating decisions, or is it more about making their workflow faster, more efficient?
It's really both, but the biggest immediate impact we're seeing is definitely on optimization, making things work better and faster. As a direct application, LLMs are amazing at parsing unstructured data, stuff that used to take humans hours. Think about claims processing. An LLM can read the free text comments in emails or doctor's notes or call center transcripts. It can pull out key facts like where an incident happened, the type of injury, specific times, and use that to instantly autofill reports. And crucially, they can also do things like scrape news feeds constantly, analyze millions of little snippets to spot emerging, maybe unusual risks like a new type of cyber threat, and then generate immediate action points for the risk management team. That's incredibly powerful.
Wow. And what about the other side, the LLM as an assistant? How are they boosting the actuary's own technical skills?
Primarily in coding and helping validate models. They act as a really powerful coding buddy, helping actuaries write, debug, and optimize complex model code, maybe in languages like R or Python, much faster than before. They're also becoming quite useful in model interpretation. An actuary can sort of discuss a model's assumptions with the LLM, get feedback, challenge correlations it might have found, maybe even ask for alternative ways to structure the model.
That kind of power, though, it must come with some serious professional responsibilities. Our sources were very, very clear. LLMs are a tool, not the ultimate decision maker. Why is that line, that need for human accountability, so strict here?
Because LLMs, well, they're prone to making mistakes that sound very convincing. These are the hallucinations people talk about. And maybe more insidiously, they carry inherent biases that come directly from the data they were trained on. So if a model was trained on historical data that maybe unfairly flagged certain demographic groups or certain areas as high risk, the algorithm could just perpetuate that bias. It might end up penalizing someone based on where they live or their past circumstances, not their likely future behavior. The actuary has a professional duty, an ethical duty, to audit that model output. They need to ensure fairness and be ready to override the algorithm's result if it seems flawed or discriminatory. And there's another big point. Using those easily accessible browser-based LLMs like ChatGPT with confidential policyholder data or sensitive company financials, that poses huge security and privacy risks. The actuary has to maintain strict control, continuously review and monitor the results the AI produces over time, and ensure that they, the human professional, remain fully accountable for the final actuarial work product. The buck stops with them. Hashtag tag outro.
Wow. This has been a truly expansive deep dive today. We've gone from, 4,000-year-old principles of risk transfer in ancient Babylon, all the way through quantifying public health solidarity rates right now and navigating these unprecedented financial risks from climate change, all while trying to integrate these incredibly powerful, yet, as you said, potentially flawed AI tools.
Yeah, and what really remains crucial, no matter how sophisticated the technology gets, are those core human skills of the actuary. That deep analytical problem-solving ability, the sheer perseverance you need to handle massive uncertainty, and maybe above all, strong communication. Being able to take these incredibly complex technical findings and explain them clearly with confidence to people who aren't actuaries. That skill is just vital for success at every single stage of their career, especially, when the findings might influence huge public policy decisions or even a company's survival.
Absolutely. And that brings us perfectly to our final provocative thought for you, our listener, to mull over. Given the immense growing power of AI to model risk and uncertainty, which has been the core job of this profession since Haley's time, how do we, as consumers, as citizens, figure out the right legal and ethical lines? When must human judgment step in and definitively override a decision that's been generated by a high-performing but potentially biased algorithm? Something to think about.